This is the second podcast on Chapter 11. We're now going to look at insourcing versus outsourcing and make or buy decisions. First of all, outsourcing is when we purchase goods or services from outside vendors. Insourcing is when we produce the good or service within the organization. Decisions about whether we should insource or outsource products are called make or buy decisions. Opportunity costs, then, are the contribution to operating income that is foregone by not using a limited resource in its next best alternative use. That's the definition. We'll get a little bit more into opportunity costs as we go through this podcast. Okay, so outsourcing and idle facilities. In order to make a good decision here, managers need to consider the difference in relevant costs between the alternatives. This will include the cost of idle capacity. That's when we don't use available facilities, such as available manufacturing facilities, and it also relates to their fixed costs. When we are looking at outsourcing decisions, it will typically have a long run horizon in which the financial costs and the benefits of outsourcing become more uncertain. So the longer we go into the future with outsourcing or with our forecast of outsourcing, the greater the uncertainty is in terms of the accuracy of that forecast. Almost always strategic and qualitative factors will become important determinants of the outsourcing decision. So we have to weigh into account our strategic decisions and other non-quantitative factors when we look at outsourcing. Weighing all these factors then requires considerable managerial judgment and care. International outsourcing requires managers to evaluate not only the manufacturing and transportation costs, but we also have to look at what we call foreign exchange risk. That's the risk when we deal in another currency that's non-US dollars, and then when we convert back to US dollars, we have to worry about potential exchange rate gains or losses that may be taken into account in our decision. There are also other strategic and qualitative factors such as quality, reliability, and efficiency of the supply chain that we need to take into account when we're looking at overseas outsourcing. The total alternatives approach, then, it just means that managers should consider all future costs and all future revenues for all products. So, for example, if one decision will create idle capacity, but that idle capacity could be used to manufacture another product, then we should consider that in the overall decision. Again, total alternatives is just like it sounds. We look at all future costs and all future revenues for all products. The opportunity cost approach, then, is the contribution to operating income that would be foregone by not using a limited resource in its next best alternative use. So deciding to use a resource one way means that a manager must forego or is unable to use the opportunity of that resource in another way. So managers must consider that cost in the decision making. The cost that they have to consider then is what we call the opportunity cost. If we decide not to go with option B and we go with option A, we still need to take into account the costs or the revenue foregone by option B. I'm sorry, not, yeah. Carrying cost of inventory. Recall that under the opportunity cost approach, the relevant cost of any alternative then is the incremental cost of the alternative plus the opportunity cost of the profit foregone from choosing that alternative. So the opportunity cost of holding inventory is the income that would be foregone by tying up money in inventory and not investing it elsewhere. So again, we're looking at what the opportunity cost is given up, or the revenue given up, if we don't go with that particular option. Okay, product mix decisions are decisions that managers need to make about which products to sell and in what quantities. So there is a decision rule with this constraint, and this is the guiding rule that we'll use, and we'll see in the following example. We should choose the product that produces the highest contribution margin per unit of the constraining resource. So we're not going to take the highest contribution margin per unit of the product. It's going to be of the constraining resource. So this is a good example of that. Look at product A and product B. If we just look at what the contribution margin per unit is, we would say, wow, product B is much higher at $15 versus $4 for product A. But now we have to take a look at what the constraining unit is, and that's machine hours required per unit. If I take 4 and I divided that by 5, my contribution margin per machine hour is $8 per unit. Here, if I take my contribution margin for product B and I divide by 3, my contribution margin per machine hour is $5. Now, we're going to look at what our contribution per machine hour is, and we see that product A actually has a much higher contribution margin per machine hour when we take into account the constraining resource. So again, product A is higher than product B. Okay, a bottleneck is a phenomenon where the performance or the capacity of the entire system is going to be limited by a single or limited number of components or resources. And the reason why they call this a bottleneck is because this is where you look at the assets from water metaphor. So as water is poured out of a bottle, if it's a bottle, it may tend to have sort of a thin neck. So the rate of outflow is going to be limited by the width of the conduit of the exit. That is that thin neck that the bottle has, otherwise known as a bottleneck. If we can increase the width of the bottleneck, then you can increase the rate at which water will flow out of the neck at different rates or frequencies. So such limited components of the system are sometimes referred to as bottleneck points. So we're trying to overcome that bottleneck point. We're trying to expand the neck so that we can get the flow to come out better. Okay, the theory of constraints, and it's abbreviated TOC, will describe methods to maximize operating income when faced with some bottleneck and some non-bottleneck operations. Again, we're trying to get that neck bigger so that we can get the water flow to come out quicker. The TOC then will define 3 measures: the throughput margin, the investments, and the operating costs. The objective of the TOC then is to increase the throughput margin while decreasing investments and operating costs. So the TOC focuses on managing the bottleneck operations. It really focuses more on decreasing any kind of costs or investments that we have to make and increasing the throughput margin. So increasing revenue and trying to hold our investments and our costs the same. Okay, there are 4 steps to manage a bottleneck operation. First of all, we have to recognize that there is a bottleneck. 2, we have to identify what those operations are. And then 3, we need to go ahead, I should say in the first step, we not only recognize the bottleneck operation, but we determine what the contribution margin of the entire system is. We then go ahead and identify what the bottleneck operations are, and we'll keep the bottleneck operation busy and subordinate all non-bottleneck operations to the bottleneck operation. So that just means that we're going to focus our attention or our resources on trying to keep that bottleneck, the neck of the bottleneck, as big as possible, even if that means that we have to go ahead and take resources away from other non-bottleneck operations. By doing this, we'll take actions to increase the efficiency and capacity of the bottleneck operations. Point 5 is important to know. The TOC will focus on short-term maximization of the contribution margin. ABC costing is a long-term focus on our contribution margin. Okay, when the cost object is a customer, managers must decide about adding or dropping the customer. So the decision rule that we're going to make is, does adding or dropping a customer add operating income to the firm? If it does, then we shouldn't drop the customer. However, if it doesn't, then we would either drop the customer or we're not going to add that customer. So this decision is going to be based on an incremental income of the customer, not how much revenue a customer generates. Again, very important, the incremental income, not the total revenue a customer generates. Let's go ahead and take a look at an example here. If we have the following customers, we can see that Vogel and Brenner are profitable customers, but it looks like Whisk is not a profitable customer. So maybe we should look at going ahead and getting rid of our customer risk. Well, if we do so, we can go ahead, we can save some money on cost of goods sold, on our furniture handling, our labor, our marketing support, sales order, and delivery processing costs that are incurred on the account. So the cost that we can save, and unfortunately they didn't show this as a slide, but in page 449 of the book, you can see that this customer WISC generates $400,000 worth of revenue. If we were to go ahead and eliminate some of the costs, or if we were to look at the costs that we could eliminate by not having WISC as our customer, we would still have the cost of goods sold of $330,000. We would have the furniture handling labor cost of $33,000. We would still have marketing support of $10,000, and we would have sales order and delivery processing of $12,000. If we add up all those costs, the other costs here, such as furniture handling equipment costs written off as depreciation, again, sunk cost, that doesn't matter. Rent, we're going to have whether WISC is our customer or not, so that's not going to matter. And then we're also not going to have, we're not going to allocate general administrating costs, and we're not going to have to worry about our corporate office costs. So the cost that we would still have would total $385,000. Again, that's the 330 plus the 33 plus the 10 and the 12. So we would eliminate $385,000 worth of costs, but we would be also giving up $400,000 worth of revenue. So the effect on our operating income would be minus $15,000. So again, we are focusing on the incremental income of the customer, not the total revenue. So here, the incremental income, if we were to get rid of WISC, would be minus $15,000. So the answer would be that we should keep WISC as our client because, again, they are contributing, there's more revenue than cost associated with this customer once we get rid of the allocations of some of our indirect costs. We're still going to have those costs whether WISC is a client or not. Okay, when a customer doesn't produce positive operating income, we need to determine why. Maybe they have low margin products that they're ordering. Maybe we can increase the price. Maybe they have a high sale order cost that's attached to it. There could be high delivery processing and other handling costs. There could be higher marketing costs. So once we identify what these higher costs are, we can work with the customer to reduce those costs so that the customer becomes more profitable. Very hard to acquire new customers in a business, so you want to maintain or keep those customers that you currently have, again, because it's much harder to get new clients. As a last alternative, if you can't make that customer profitable, well then, unfortunately, you're probably going to have to let that customer go. Okay, customer profitability analysis, when we look at relevant revenue and relevant cost analysis, there's at least one distinction between relevant costs of adding versus dropping a customer. Depreciation cost will always be irrelevant in deciding whether to drop a customer because depreciation on the equipment has already taken place. We've already purchased that equipment. It's a past or a sunk cost, so it has no bearing on our decision going forward. However, the cost of purchasing new equipment in the future will eventually be written off as depreciation and is a relevant cost in deciding whether to add a new customer. Sometimes companies must decide about closing or adding branch offices or business divisions. So this analysis will be similar to the decision process of adding or closing a customer, with a notable exception. Often branches or divisions are allocated a share of corporate office costs. So if we decide to close a branch or division, these costs still need to be allocated differently, but in total they may not actually be changed. So what we're saying is, if we decide to close down a branch or division, the indirect costs still have to be allocated to the remaining branches or divisions. And if we do that, it's very possible that other branches or divisions may become unprofitable as well. So in total, those costs will not change. It's just a matter of how we reallocate it to the remaining branches or divisions. Some items of cost that are not relevant include cost, accumulated depreciation, and book value of equipment. and any potential gain or loss on the transaction. Any gain or loss on the transaction is what we call a financial accounting phenomenon only. What we need to do is consider the book value and the current disposal value of the old machine separately. Book value, again, that's not relevant. However, the current disposal value of the old machine is. That's how much we can sell the old equipment for in the future. Book value doesn't matter. That's not going to change. Other items of cost that may be relevant include, again, the current disposal value of the old machine and the cost of the new machine. Decisions and performance evaluation. Despite the quantitative nature of some aspects of decision making, not all managers will choose the best alternative for the firm. They may do what's best for their own pocketbook, which again would not be the correct decision. Managers will consider how the company will judge his or her performance after the decision is implemented. They're always going to be thinking about that in the back of their mind. So many managers consider it unethical to take actions that make their own performance look good when these actions are not in the best interest of the firm. Again, any actions a manager takes should be in the best interest of the firm, not in the best interest of his or her own pocketbook. The decision model analysis can also dictate a decision that should be made in the real world, but would the manager actually follow it? Managers frequently find it difficult to resolve the conflict between the decision model and the performance evaluation model. Why? Because one, the decision model benefits the company, the performance evaluation model benefits or could hurt the manager. So in theory, resolving the difficulty seems obvious. Managers should design models that are consistent. Again, that's harder to do in the real world, but in theory, that's what should be done. Okay, that will end the second podcast on Chapter 11.